In our previous videos, we have been discussing the basics of machine learning. In particular, we spent lots of time to study statistical machine learning, some of the Bayesian-based techniques that allows us to do both classification and regression. And then we moved on to study neural networks, right? And we have been using the handwritten digit dataset, MNST datasets, to study how to use neural networks to do classification work. The examples that we have been using is either from whale logs that are kind of useful for geologists, for rock physicists, or from MNST, the handwritten digit images. But now let's use a different kinds of data set. Let's try to use stock data. Let's use stock data, those financial instruments, the prices of those financial instruments, as our example data set, and try to study more deeply about deep learning, the deep neural networks, right? And see if we can actually make some progress, both in understanding artificial intelligence and also see if we can do something about applying deep neural networks to the financial market, right? I think that might be a more interesting data set or example data set than whale logs or the MNST data set, right? And it's kind of relevant to lots of people, right? But before we actually talk about specifics, I have this disclaimer, right? All examples and code presented in any of my YouTube videos are technical and illustrative in nature and do not represent any financial recommendation or investment advice, right? The idea of using machine learning in the stock market is not really new, actually. One of those pioneers in applying machine learning techniques in the stock market is Jim Simons, right? He's a MIT mathematician. He's a MIT professor in mathematics, and he actually has huge achievements, very high achievements in mathematics. And he founded this Renaissance Technologies. Right, that's one of those earlier hedge funds that actually use machine learning to make profits. One of his earlier strategies is called the mean reversion strategy. Right, he's trying to capture the turning points of price actions. So the basic idea is that the price is going to be oscillating around the so-called moving average. Right, so if it deviates too far from this moving average, it has a tendency to go back towards the moving average, right? So it's basically the idea is relatively simplistic, but once it comes to implementation, there are lots of details that you have to consider, especially risk management, because it's not following the trend. It's actually trying to capture the turning point of the trend. So the risk management of these kind of strategies are kind of very, very important. And at the beginning of his hedge fund career, the return was pretty high, right? 39-40% every year, right? But as time goes by, more and more people start to use the same kind of strategy and start to learn about this kind of machine learning techniques. The return diminishes very quickly. So people start to explore more sophisticated techniques or machine learning techniques to make profits. These days, these models, those quantitative models, have become really, really sophisticated, right? But the basic idea is still based upon pattern recognition. It's a statistical machine learning technique that's actually quite different from deep learning or from deep neural networks. For example, it's quite different from AlphaGo, right? Um, so what's so different about AlphaGo, right? So what's so different about AlphaGo, and why I think deep learning or those kind of very deep neural networks, or this kind of a so-called um, reinforcement learning, is so useful for financial market is based upon two observations, um, two similarities between playing the Go. This is some kind of a chess game, right? And there's two similarities between Go and the financial market. Um, One is about this kind of so-called delayed reward. The delayed reward is something that's really important in financial market, because some of the investment that you made early on may not give you a reward immediately, but it may give you a substantial amount of reward after some time. Right? After some time, this kind of delayed reward is a typical feature of the financial market, and it is also a very typical feature of this Go game. Some of the moves that you made at the beginning of the game uh, plays out to be extremely important in the middle of the game after hundreds of moves between the two players, right? This kind of delayed reward is quite difficult to be captured using pattern recognition techniques like traditional statistical machine learning methods. But you can actually capture that by using the so-called Q-learning or reinforcement learning, right? This is some kind of a similarity between Go game uh, and the financial market. A second similarity that I found to be quite important is the size of the sample space. The size of the sample space. For a typical Go board, you have 19 horizontal lines and 19 vertical lines. So that's how many crossings. That's 19 by 19. That's 361 crossings, right? At every crossing, you can choose to either uh, place a stone or do not place a stone. So you have two choices, right? That's 2 to the 361's power, right? That's a huge, astronomically large number, right? And this kind of a sample space hasn't actually considered uh, the sequence, the ordering of placing those stones, right? So if you consider the ordering, the entire sequence, then the sample space is going to be astronomically large. It's going to be even larger, right? Much larger than 2 to the 361 power, right? The same is true for the financial market. The same is for you have to consider how many financial instruments you are actually dealing with, right? At least for the American stock market, it's you have at least like 8,000 stocks that you can trade, right? And if you consider the Bitcoin, the digital money, and also other kind of instruments, the bonds, right? That's kind of a huge number of instruments, right? And for every instrument, you have to consider your position. Is it a long position or is it a short position? You have at least two choices, right? Um, and you have to actually consider the time sequence of your position, right? If you are doing this kind of daily trading, if you are doing daily trading, then you have to actually make a decision at least daily, right? And if you're actually working on intraday trading, then you have to sort of make a choice every sort of 5 minutes or 15 minutes, that kind of thing. So if you consider all those kind of different choices, both in the number of financial instruments and also in the time sequence, the size of the sample space is also extremely large, right? That's a second similarity between AlphaGo and between playing the Go game and also the financial market, right? So if AlphaGo, this kind of a deep neural network or artificial intelligence can beat the world champion in Go, right? There might be a chance for deep neural networks to make a profit in the financial market also, right? That's that's my thinking about why those stock prices or stock data could be a good example for us to actually study deep neural networks, right? Um, some of the questions I got from students was about um, there's already so many automatic trading bots on the financial market. Lots of the trading were actually done by robots, right? It's not really done by humans, right? So if the AlphaGo can beat a human being, can a deep neural network beat other trading bots on the financial market? Is that going to be just a purely just a game, or um, this kind of a competition between different kinds of trading bots, or is there any place uh, for 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 a certain trading bot to perform better than all the rest of the trading bots, right? My understanding of this is um, kind of a based upon this article by Robert Shiller, right? This guy is a professor of economics at Yale. Um, my understanding is that so at the beginning of the article, he raised this question directly: will alpha eventually go to zero for every imaginable investment strategy, right? So by alpha, he means that it's this kind of extra sort of profit that you can make, um, that's kind of exceeding the profit you can make from the ETFs, from those passively managed ETFs like SPY, right? Um, if you can, so suppose alpha, suppose SPY is increasing by 8 to 10% every year. If you can do better than that, suppose you can do like 20% every year, then this extra 10 or 12% of profit is called alpha, right? So the basic question is that this extra profit, is it going to eventually go to zero for every imaginable investment strategy? Um, once the financial market is all traded by automatic robots, right? Um, so 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 the answer to this, if you don't have the patience to read the entire article, the answer, or at least the opinion of Robert Shiller is this: human judgment, good and bad, will drive investment decisions and financial market outcomes for the rest of our lives and beyond. So no matter how smart the computers are, human judgment will always be the fundamental drive of some of the decisions and financial market outcomes, at least for the foreseeable future, right? Um, so 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 at least at the current stage, uh, it's impossible to remove human judgments from all those trading decisions, right? And if human judgment is kind of a very important part, then it is possible to train a artificial intelligence to take advantage of the errors or mistakes in those human judgments to actually make extra profit. Um, but again, that's my understanding or my opinion about uh, why I think it's actually possible. It's actually possible to train a deep neural network to actually make profits on the stock market, right? Um, um, and we're gonna use actually real stock data. So we're gonna use real stock market data from to for our future examples, right? If you look at, so this is from TradingView. If you have experiences of dealing with financial data, then you may know about the TradingView, right? It's a quite popular website um, for looking at the price movements and also the volumes, the trading volumes of each of the different kinds of instruments, right? This is for TQQQ, right? QQQ is a ETF that tracks the Nasdaq, and TQQQ is kind of leveraged. It's a 3 times leveraged based upon QQQ. And if you look at every, so the the symbols, the symbols that you are looking at is called a candlestick, right? So every candlestick, for example, if you just look at the last one, right? If you just look at the last one, the for every candlestick, you pay attention to the color. So if it's a green symbol, then it means that the opening price is lower than the closing price. So for every day, so every candlestick represents the price for every day, and you have 4 prices. The opening price, it's the price of that particular instrument at the opening clock, at the opening time of the market. That's like 9:30 a.m. Eastern time, right? So you have the opening price, and then you have the closing price. Closing price is 4 p.m. Eastern time, right? Then that's the closing price. Closing price, if it's a green candle, then the closing price is higher than the opening price. And then you have this whisks. You have this whisks. This whisks actually represents the range of price fluctuation within the day. And the highest point of the whisk is the highest point or the highest price reached by this particular instrument within this last day, right? And then the lowest price point is the lowest price reached by this instrument within that day, right? So you have 4 prices: the opening price, the closing price, the highest point, the highest price, the lowest price, right? And if it's a red bar, if it's a red candlestick, it just means that the opening price is higher than the closing price, right? So the color actually represents is it a up day or is it a down day, right? And then the whisks actually tells you the range of fluctuation within the day, right? So and then that's the price action, right? And then you have trading volumes. Trading volumes. The color of the trading volume is actually similar to the color of the candlestick, right? And then you have in some of the days, lots of people are sort of trading in the market. Then you have a higher volume, and then in some of the other days you have lower volume, right? And then the 3 lines that I added on this candlestick are moving averages, are just moving averages, right? In the past, you can sort of see why this mean reversion strategy actually works, right? So if the price actually goes above the 20, so the Y line is the 20-day moving average, right? And the red line is 60-day moving average, and then this blue line is 120-day moving average, right? So if the price actually goes above the 20-day moving average, it tends to come down and towards the moving average, right? And then if it goes down too much, it has a tendency to go back, right? But in the past few days, it has been moving down even past the 60-day and 120-day moving averages, right? So it has a tendency to actually go back to the moving towards the moving average, right? And this is sort of the the basic idea that we are going to try to follow in our trading strategies, right? We are going to try to actually train a neural network using the so-called reinforcement learning, right? Reinforcement learning to actually make trading decisions for us and see if we can actually perform better than the overall SPY or other kind of large market ETFs, right? Passive ETFs. So that's for this video, right? And we're going to talk about how do we actually set up this kind of a example, or set up this kind of a environment for us to write some codes, and what kind of libraries or software packages we are going to use, right? TensorFlow is a must, right? We have to use some of those existing machine learning libraries like TensorFlow, right? And then we are going to use Keras, or I don't exactly know how to pronounce it, Keras, right? And also Pandas. Pandas is a quite a useful tool, right? That's it. Thank you for watching this video.